Hello, good morning everyone. This is CA Rakesh Mittal and I would like to welcome you all in today's webinar on media and entertainment industry, which is being organized by Committee for Members in Industry and Business of the Institute of Chartered Accountants of India. A committee has taken initiative for conducting webinars under the leadership of CA Durgesh Kabra sir, uh, our chairman of CMIB, and CA Rohit Rovadia sir, vice chairman of CMIB. And I, I welcome to I welcome our speakers, CA Isa Sekhri ma'am and CA Rajesh Mehra sir, who will enlighten us on today's topic. So now I would like to introduce our first speaker, CA Isa Sekhri ma'am, who will enlighten us on taxation of individual in media and entertainment industry. Please, ma'am.
Good morning, everyone, and welcome to this session on taxation of individuals in the media and entertainment industry. At the outset, I would like to thank the Institute of Chartered Accountants of India for giving us the opportunity to present before you today. So without taking much more time, let me share my screen and we'll go through the presentation. All right. So this is going to be the structure of our session. We will start off with a little bit of a background. Then what we're going to be discussing today is taxation of all individuals in the media and entertainment industry. That is your actors and entertainers who perform on screen, perform on stage, and also other people who are involved, like your technicians, your cameraman, your director, your lyricist, all those people who are actually behind the camera. So we will be discussing their taxation, both in India and outside India. And so what is a cross-border taxation? Now, why is cross-border taxation important? Sorry. Can you see my presentation, right?
Yes.
Yes, okay.
Yes, ma'am. Yes.
So why is cross-border taxation important? Cross-border taxation is important because of the recent developments that have happened in the media and entertainment industry. Now, as we have in other spheres, the world of film business is also becoming a global village today. So there is a selective movement which is happening from your Bollywood to Hollywood and vice versa, both of actors, entertainers, and even your creative team. So you have your acclaimed Bollywood actress Alia Bhatt, who recently appeared on Heart of Stone. And there have also been a bunch of these smaller appearances by Hollywood superstars in Bollywood movies, right? So foreign film producers have also been shooting films in India with or without Indian actors. And also regardless regardless of whether they are meant for an Indian audience, say for example, an Eat, Pray, Love. This has led to a cross-border movement of entertainers, creative professionals, and technicians, right? So both those people coming to India and hence their taxability in India, and our actors and technicians going outside India and hence their taxability outside India. Now, in the Indian media and entertainment industry, broadly, we have three categories of individuals, right? So you have your entertainers, your actors, dancers who perform on screen, singers who record songs, and actors who basically lip sync the songs for the cameras while the actual singer does not appear before the screen. But now you also have the singers doing live shows. So, right, in those cases, they are performing on screen as well. Then you have your creative team other than the entertainers, which is your directors, casting directors, story, script and dialogue writers, lyricists, stunt coordinators, art directors, set designers, costume designers, hairstylists, makeup artists, and choreographers. And then you have your pure technical team who use their technical skill sets to perform, like persons in department of photography, editing, sound recording, animation, special effects, and such similar work that they do. Now, because of all of these, there are lots of new issues that are coming up in the taxation of individuals in the media and entertainment industry. Now, let's go to the first category, which is actors and entertainers. So, earlier, the word actor or artist was primarily used to denote a performer. However, recently, there's a new genre of individuals called entertainers, which has now evolved, which includes individuals who may act or may not act. And in fact, recognizing this specific treatment that is given to them, the OECD language of Article 17, which is the language which deals with taxation of artists and entertainers, they have actually replaced the term artist with entertainer. In fact, the Finance Act was also amended. Our own Indian Finance Act was amended, where a new section one, where the section 115 BBA had replaced the word actor with also with entertainer. Now, why that? Because the word entertainer is apt because it has a wider meaning and it includes in its ambit anyone who entertains. It could be a dancer, a singer, a comedian, like you have these, Mike nights, where these comedians are performing, right? So they are not actors per se, but they are comedians, right? Even someone who maybe anchors a show. But it also excludes the artists in the earlier sense of the term, like a painter, a sculptor, who is actually an artist, right? But what we are covering here is someone who's actually entertaining, someone who may or may not act, but someone who's actually doing a performance, either in a movie on the screen or a live performance. So that is why there is a whole different genre called entertainers, which has now evolved, and nobody uses the term artist or actors anymore. Let's go on to let's go on to some basic judicial precedents that we have in India on the term actor, right? Because there are different categories that were covered here. Now, there was an earlier section, erstwhile section 80RR of the Income Tax Act, which provided a deduction to the income of certain artists and actors who earned income in foreign exchange. Now, the issue under consideration here was whether Mr. Amitabh Bachchan's performance in Kaun Banega Crorepati was as an actor, right? Because here he's not really acting, right? He's himself, he's being an anchor of Kaun Banega Crorepati. So the question here was before the Mumbai tribunal whether Mr. Amitabh Bachchan's income that he has received by being an anchor of Kaun Banega Crorepati is as an artist, right? So the Mumbai tribunal held that the various meanings assigned to the term artist by different standard dictionaries clearly show that the term artist is a term which has a wide meaning and not merely restricted to the meaning of fine arts, but encompasses within its scope a skilled performer, right? So that is, one observation that was made by the Mumbai tribunal on the term artist and actor. On a similar issue, there was a question raised that when Mr. Sachin Tendulkar, okay, he's a cricketer, right? But when he appears in commercials, can he be called an actor? And then can he get the benefit of this specific section? Now, the section is not there anymore. These cases we're just discussing for reference. In his case, also the Honorable Mumbai Tribunal held that yes, when he appears in commercials, he's actually being an actor and he's not a cricketer at that time for the purpose of this specific section. Other case laws on this section which discussed the word actor were Tarun Tehlani, who's actually a dress designer, right? And he was also covered under an actor because he was doing a performance on stage. Harsha Bhogle, who's a commentator, was also considered an actor for the purpose of Section 80RR. So now the other thing is that in the case law of Pilcom versus Income Tax Officer, in this case, the Calcutta Tribunal had a question that whether the players of the cricket associations in the participating countries in the World Cup Cricket Tournament 1996 should be considered as entertainers, right? And in that case, it was held that even they need to be considered as entertainers. Now, let's go on to a decision from the Canadian, tax court of Canada, basically. Here, the case law is whether a radio broadcaster can be considered as a radio artist, right? So this was in the context of the US-Canada tax treaty. Here, the Canadian tax court held that it is obvious that athletes and sportsmen perform in their chosen athletic avocation, and their performance is inherently entertaining. The fans who turn on the radio to hear a particular baseball game want to know how the team is performing on the field. While he may be able to hold the interest and attention of the fans during the commentary, but he is not the reason why they turn on the radio. So in this particular case, they said no, he's a radio broadcaster. If I'm a fan, I'm switching on the radio to understand how the match is. I'm not switching on the radio to hear him, right? And which is why he cannot be considered as a radio artist. But now this is an old case law. Having said that, it is the principles of this case laws are still relevant. Another issue that comes is our very own IPL issue, right? Can it be said that the IPL actually has more entertainment value than being a sport? There are these artificially crafted teams. All players of Mumbai Indians are not from Mumbai. Similarly, for your, Chennai Super Kings or any other team for that matter. Now, the view that is being held is that they are also performing as entertainers, but there is no specific case law on IPL at the moment. Now I should just tell you over here that Article 17, which deals with taxation of artists and entertainers, and the tax treaties and Section 115 BBA apply in equal measure to both sports persons and entertainers. Now let's go on to some typical questions that get raised for individuals being your entertainers in the media and entertainment industry. The first point is your method of accounting. Now, resident entertainers generally adopt cash system of accounting. That means that he will only be liable to pay tax on the income which is received by him and not on the income which accrues to him. This is because the payments of professionals may not be regular and there is a risk of some outstanding fees not being paid or being paid at a discount. So, and then as per Section 44AA, read with Rule 6FF of the income tax rules, notified professionals in the film industry include a film actor, cameraman, director, dance director, singer, lyricist, and they are required to maintain specific books of accounts and other documents such as a cash book, journal, ledger, bills, and the other ones that are. So these are the general documents that you have to maintain under 44AA. And the notified professionals are under Rule 6FF, specifically for this film industry over here. Now, the cash system versus mercantile system causes some issues which are common to other people also who follow a cash system. Because under GST, you have to follow mercantile only. 26AS also, the person who's paying you will probably do it on mercantile basis, right? So this will cause your mismatch in GST turnover, mismatch in 26AS, and you just have to prepare detailed, recos. Here, because the film industry is now becoming more organized, there is more certainty of payments, more advances are taken, and payments are received in time mostly. A lot of entertainers are also moving to a mercantile system of accounting, primarily because of the fact that under GST, you have to do mercantile only, and it was causing a lot of problems in the turnover mismatch, and similarly in Form 26AS also. So a well-established entertainer today is probably moving to a mercantile system, but 90% entertainers are still following cash system. Now, under income tax, there are no specific provisions that are applicable to artists and entertainers. There's no separate section for it. It's the normal taxation of any professional. So, if it's over 50 lakhs or now 75 lakhs, your tax audit is applicable. And all the general rules that are applicable as a professional are applicable to him as well. Now, let's go on to typical issues, right? So, sometimes in this, so let's go to 4 typical issues. One is the method of accounting for dual performance. Now, if an actor, right, is also say being a producer for a movie, right? In which case he's performing a dual thing. He's doing an actor and a film producer. For an actor, I can continue following cash system, but as a film producer, I will have to follow only mercantile because it's business. Hence, you have to maintain two separate books of accounts, one for actor and cash and one as a producer under mercantile. There is a decision of Mehul J. Sumaya of the Mumbai Tribunal for that. The next point is a remuneration received in kind. Now, over here, it is essential to differentiate between a gift and remuneration received in kind. Now, it is not uncommon to read that a producer gifted a premium car to a particular actor, right? Now, I don't know whether this is a gift for personal appreciation or it is lieu of professional fees. So here you have to figure what that one is. So you have to then decide. So for example, if I'm doing an endorsement of a car and I've received part remuneration in cash and part I have received the car itself. In that case, all of it is my professional fees. If it is my professional fees, then ideally the person who's making the payment should first deduct TDS on the market value, on the fair market value. I also have to fulfill my GST obligations on that, right? Then it gets added to my total income. I claim expenses and pay tax on the balance amount. However, say somebody's just gifted me a car just like that, right? And in appreciation, it's not in lieu of remuneration. In that case, you have to figure the market value and then pay tax under 56 to 10, right? Because the value will obviously more than be 50,000. In that case, though, there will be no TDS and GST, then that becomes a gift. So it's very important to differentiate if it is a gift or a remuneration. Both cases, it is taxable for sure. But if it is remuneration, then you have TDS and you have GST, which applies as well. On gift, that won't be applicable. Then the other question is, what happens if you receive remuneration by way of distribution rights or a percentage of share in the revenue or the profits? Now, what happens is that there is a recent trend that actors, apart from having a fixed remuneration, like you would have heard someone said, oh, this person charged only 1 rupee for this film. But 1 rupee he charged upfront as his fees. He also took a share in the distribution rights, or he took a share in the revenue or profits that the film makes. Now, here the question comes that when this person is receiving these rights, right, in the profits, when would they be liable to tax? Would they be liable to tax on the completion of the film or the actual realization of sale of rights, whether by way of advance before completion of the movie or post-receipt completion of the movie? Now, in this case, our belief is that it would be taxable when I receive the right to exploit and some amount is fixed on it, right? Because distribution rights get taxable under a separate Rule 9B, which we're not covering today. But in that case, Rule 9B would be applicable and not the normal provisions. So in that case, you would have to follow mercantile system and follow Rule 9B only. If it is entitled to an overflow in the film, then that can be taxable on receipt basis also, because overflow is very uncertain and you cannot assign any value to that right. The other question that is typically coming up is the expenses that can be claimed. For example, makeup, dresses and costumes, any gym expenses. Now, for an actor, right, how they look, what they are doing, what are they wearing in public, all of it is part of their professional expenses, right? So you can actually claim, say, 50% of gym expenses. If you specifically bought something to wear at an award function, for example, cost of that outfit can be claimed. Makeup cost can be claimed. So what we recommend is that, you cannot say it's 100% for professional, right? So there you keep a limit and say maybe 50% is for professional, 50% is for personal, and something which is really, really specific to my professional, endorsement activity, for example. So the part of the endorsement activity says that you will need to buy your own costume or you will need to buy your own dress. That case, you can claim 100% as well. But mostly we follow the principle that we should claim only 50%. Now, let's go to cross-border taxation of individuals in the media and entertainment industry. This, as we discussed, there are lots of shootings in India and outside India. Cricket matches were being played in India, outside India, IPL. Events are being held, your shows, award functions are being held, live shows are being held. So all of this is causing movement of actors and entertainers within India and outside India as well. Now, what happens is that whenever we have this cross-border movement, right, we have to remember that their duration of stay in that country is very minimal, right? So somebody will go for a shooting, they'll go for a 10-day shoot and come back. Somebody will go for an event, they'll go for 3 days and come back, right? Hence, the characterization and taxation of such income by the country of residence and country of source is very, very relevant, because the contracts can also be structured in very creative and complex ways, and the quantum of amounts can be fairly large at sometimes. Also, an essential part of income is derived from touring from one country to another. So it is very difficult sometimes to even decide in which country they are actually a resident. And a lot of times these actors some want to transfer their domicile from a high tax country to a tax haven, okay, so that they are paying lesser tax on their income and maybe not paying tax on global income. That is why it is very relevant to first understand the broad streams of income that are earned by the entertainers and sportsmen and their character, and then decide how they will be taxed. We will first start off with the principles laid down in the OECD Model Tax Convention, the guidance available, and then go on to understand their taxation. Now, the OECD actually recognized the exceptional treatment to be given to the taxability of entertainers and sportsmen that is covered under Article 17, which provides their principles of taxation. Now, to give you a slight background, in 1959, they published a report called the Elimination of Double Taxation, which recognized the special treatment to be given to articles and entertainers and sportsmen. Thereafter, in 2010, they released a discussion draft for the changes to be made in Article 17, because initially it was called Artists from Public Performance. Now they introduced this article, 2010, they introduced a discussion draft where they said that artists will be replaced by entertainers, appearance will be replaced by performances, and prize money was specifically included because a lot of the income comes from prize money for sports persons. They also included what will happen in case of simultaneous broadcast of a live event. And there were other provisions which were clarificatory in nature. All these changes were incorporated in 2017, and the current version of Article 17 has incorporated these particular changes. Now, there are three model tax conventions: OECD Model Tax Convention, UN and US. Today, we will be focusing only on OECD because very few countries actually follow the UN and US model of taxation. Okay, sorry. Now, let's go to the OECD model of Direct Tax Convention, Article 70. It reads as, notwithstanding the provisions of Article 15. Article 15 is basically independent personal services, which we will discuss when we discuss the taxability of the other professionals involved in the media and entertainment industry. Income derived by a resident of a contracting state, such as an entertainer, theater, motion picture, radio, television artist, or a musician, or as a sportsman, from that resident's personal activities, as such exercise in the other contracting state, may be taxed in that state. State over here means country, right? So what it basically says is that if I am a resident of India and I am an entertainer and I go and perform in the US, then US maybe can tax me under Article 17. When it says can be taxed, means that they have the right to tax. It is up to them whether they want to tax me or not. Then there's Article 17(2), which says where income and is exercised by an entertainer or sports person acting as such accrues not to the entertainer or sports person, but to another person, That income may, notwithstanding the provisions of Article 17, be taxed in the contracting state in which the activities of the entertainer or sportsperson are exercised. Now, Article 17(1) covers situations where the income is derived by the entertainer or sportsperson himself or herself. Article 17(2) covers situations where entertainers or sportsperson is employed. Say, for example, there's a one-person company. And in that case, the country where the performance takes place may take an appropriate proportion of any remuneration which is paid to the individual. And if that particular country does a look-through approach for such entities, then they can even treat the income as directly accruing to the individual. Now, basically, what we have to understand why this Article 72 was added was because a lot of people kept taking income in their companies instead of taking the income individually and got out of Article 17 completely. So this was introduced to ensure that the country of performance was getting their share of taxes. So it doesn't matter whether the individual is billing in their individual name or they are billing through an entity. Both cases are now covered. Article 17 does not provide for any time threshold or any fee threshold up to which the income derived by this entertainer or sports person will not be taxable in the source country. There are some treaties entered into with India which do provide for a time and fee threshold, which we will discuss briefly today. Now, what we also need to understand is that Article 17 does not provide any tax rate as well. So now it is left for the domestic countries' laws to provide for such things. So now, for example, let's say that Arnold Schwarzenegger came to India to do a show, right? Now, under the India-US treaty, right? So let's assume that this is what it reads. How would Arnold Schwarzenegger's income be taxed in India? This particular article does not give any threshold on number of days, amount received, what should be the rate of tax. Now, if you look at an FTS article, on the other hand, it will always tell you that rate of tax is, say, 10%. If you look at it as IPS article, it will say that, okay, the individual should not have a fixed base in India and should stay at least 90 days in India or at least say 183 days in India. No such thing is mentioned here. Now, we will come to section 115 BBA, but the domestic tax of India says that 20% is the rate of tax applicable. You have to also withhold tax at the same rate. So if Arnold Schwarzenegger comes to India, he has to pay tax on 20%, 20.8% with cess, and I'm assuming no surcharge for a moment. And that is the rate of tax he'll have to pay. And that is the rate of tax at which the organizer will have to deduct tax. And that is also, and he will also have to file a tax return in India. Now, this is for your reference, the US UN model, right? Which, then talks about Article 14 and 15, which is notwithstanding, which is a dependent personal article clause. This is just for reference, right? We are not discussing the UN and US article today. Okay, now let's go to what is the scope of Article 17. Scope is basically the entertainer is resident of one country and income from performance of personal activities is in another country. The example that we just discussed, Arnold Schwarzenegger comes to India, or say Alia Bhatt has gone to do shooting for the Netflix show. So this applies irrespective of number of days stay in the country of performance, and it is distinct from other articles that since there's no threshold on the number of days stay. Now, there are these theses of Mr. Milan where he had given certain criteria for applicability of Article 17. The first criteria is that there must be a performance. The performance must be in public, either directly before an audience or recorded and later on produced for an audience. The predominant element of performance must be artistic and entertaining. So the level of the artistic or entertainment skill is irrelevant. The performer himself or herself should be the direct or indirect reason why the audience is listening to or watching the performance. So, what does this include? It includes a stage performer, film actor, dancer, singer, comedian, actor for including for instance a former sportsman who comes in a television commercial, but it does not include a visiting conference speaker, administrative or support staff, cameramen, producers, directors, choreographers, technical staff, a former politician who maybe receives fee for his speaking engagement, a model performing presenting clothes for during a fashion show or a photo session, since there are no performance happening over there. So if there is no performance, Article 17 does not apply. Article 17 applies if there is a performance. Now, for an entertainer that we discussed, right, it can be more than one role. You can have director show and act in it, like how Amir Khan does, right? Amir Khan will be an actor. He will also be a director, right? In that case, you have to bifurcate the income, right? Which difference between the performance as an actor and difference between the performance under any other role. So to the extent it relates to performance as an actor, Article 17, and to the extent it relates to any other role, then you have to discuss between IPS and FTS, which we will be discussing after we discuss entertainers. This we have already discussed. Okay. Now, let's go to what is the income covered by Article 17. Income received by an impressor or an agent for arranging the appearance of an article or sportsman is not covered by Article 17. Income received by them on behalf of an entertainer or sports person is covered by them, right? And Article 17 also applies regardless who pays the income. It can cover prizes, awards, everything. Article 17 is not applicable if there is no direct link between the income and the performance of activities by the entertainers or sports person. It applies to income which is received from activities which involve political, social, religious, or charitable nature. If an entertainment character is present, it is applicable regardless of who pays the income, and income received by the agents is not applicable, but it is applicable if they receive it on their behalf. Now, for the income which is covered under Article 17, right? Any remuneration for performance, which is directly or indirectly, is covered under Article 17. But actors also get income which accrues to them, but it will not be covered by Article 17 because it is for other than their performance. For example, any royalty, sponsorship, image rights, any merchandising, advertising fees, payment received if an event is cancelled, payment received for simultaneous broadcasting. So basically, for example, let's say there's an actor and this actor has given his image rights to make a video game, right? That is not coming from performance of the actor. So that doesn't get covered under Article 17. Or for example, merchandising. And that is not again covered under Article 17. Then there are other incomes under which there is no guidance given under Article 17 as to whether Article 17 will apply or not, right? So, for example, there is income which is received from restrictive covenants, pension, any standby time for sportsmen, any player transfer fee, for golden handshakes. All of these are something that is not covered under Article 17. But let's discuss them and understand whether this will apply and how will this apply. Any standby time for sportsmen, right? Standby time means that somebody is like, beyond the 12th player and he's waiting in case he's called, but he gets paid for those many days, but there's no performance by him. So that should ideally not get covered under Article 17 because the main point being performance. A player transfer fees, the last few days we've been listening to the IPL auctions, right? This player got bought out for so much, this player got bought out for so much. Now, this player transfer fees, which was primarily predominant under football outside India, has now become very, very popular under IPL, under cricket in India as well. But again, the player transfer fee that the person is getting is not from a performance. It is basically somebody buying you out and hence not covered under Article 17. Similarly, for a golden handshake, it should ideally not be covered under Article 17. And a restrictive covenant may be definitely not, because here I'm getting money to not do something, right? So hence, these income, even though no guidance is given, because we believe that there is no performance here, it should not be covered by Article 17. Now, let's go on to Article 17.2, right? And Article 17.2 covers, the one we discussed earlier, that Article 17.2 covers cases where the income from performance accrues to a third person. Now, paragraph 1 deals with income derived by individual entertainers and sportsperson from their personal activities. And here, paragraph 2 covers when it accrues to a third person. Here, as we discussed, the country of performance has a right to look through the person who is receiving it and tax it in the hands of the individual directly. Now, there are three kinds of situations that can be covered here. The first is a management company which receives income for the appearance. For example, a group of sports person, which is itself not considered as a legal entity, right? The second is a management company which is constituted as a legal entity. For example, there's a team or a troupe or orchestra. And income from performances may be paid directly to this entity, and the team who's performing may be paid a salary from there, right? The profit element accruing from the performance to the legal entity will be taxable under Article 2. The third situation actually covers certain tax avoidance devices in cases where remuneration for the performance of an entertainer or sports person is not paid to them itself, but to another company. It's called so-called star company, in a way that the income is taxed in the state where the activity is performed, neither as personal service, nor as sports person, and nor as the profits of the enterprise, because there is no P. So, for example, I make a company outside India, I go and perform, and then I take income in that country, but I don't have a permanent establishment, and hence I'll say that there is no taxability, right? So because of this, they had come up with Article 17.2 saying that it doesn't matter who's receiving it, and hence this is covered. What is also important to note down over here is that paragraph 2 is applicable even to cases where the entertainer and the star company are tax residents of different countries. So the paragraph allows the country in which the activities of an entertainer or sports person are exercised to tax the income regardless of the provisions of the convention and any other provisions that may be applicable, right? So hence, I may be resident in India, I may open a company in Singapore and take the money in Singapore. Even in that case, if I'm performing in the US still has a right to tax the Singapore company also. It doesn't matter that I'm not a resident of Singapore. But Article 17.2 does not apply to any prize money which is derived by the owner of, say, a horse or a race car's owner from the results of the horse or race car during the race. In such a case, the prize money is not paid in consideration for the personal activities of the jockey or the race car driver, but in consideration with the activities of ownership and training the horse, or the design or construction, ownership or maintenance of the car. Such money is not derived from the personal activities of the jockey or the race car driver, and hence not covered by Article 17. So, if I am the owner of a race car, but say I have an F1 driver who's driving it, the driver's income is under 17, but my income that I get, profits, if the car wins, then that is not covered under Article 17.2, because there is no performance by me. The performance is by the driver. Similarly, a jockey, and I am the one who's owning the horse, right? The money that I get if my horse wins, that is not taxable under Article 17 because it's not my performance. The jockey's income is covered under Article 17. Now, paragraph 2 also covers income that may be considered to be derived in respect of personal activities of an entertainer or sports person, even though that covers income which is received by an enterprise that is paid by performing such activities, such as a sports team or an orchestra. It does not cover income of all enterprises that are involved in the production and entertainment or sports events. For example, the income which is derived by an independent promoter of a concert from sale of tickets and the allocation of advertising. Anything that is not in relation to performance is not covered under Article 17. The intention of Article 17 is to not tax the income of the entertainer or sportsperson twice through the application of 17(1) and 17(2), right? So either one will be taxed, either the company will be taxed or the individual will be taxed, but there is no reason to do it. So the intent is not to tax doubly. The intent is to only ensure that the income is taxed in the country of performance. Now, as a general rule, regardless of Article 17, the GAR provisions of the domestic rules of the source country could be applicable. So whether or not 17(1) is applicable, 17(2), if there is GAR applicable, like how GAR is applicable in India, that could still be applied. Now let's go to the computation of income under Article 17. The manner of computing income under Article 17 is not provided, right? So, for example, an FTS clause will say it is taxable at 10% on gross basis, right? But this article does not have any tax rates provided and does not have the method of computing it also. So you have to go to the domestic laws of the country, the source country, which will be very, very different in each country. So for example, if your client is, say, going to the US to perform, I would definitely recommend speaking to a CP over there to figure out what is that person's tax liability in the US, right? And similarly, if you have someone who's coming to India to perform, we will discuss 115 BBA as to how their income is taxed in India, because that is the domestic laws of India, because Article 17 does not provide any method of computation. So there are some countries may consider taxation of gross amount, with some countries may allow taxation of net amount, some countries may allow expenses, some countries may not allow expenses. Okay. The other thing is that sometimes performances are supported by public funds, right? In which cases, sometimes they may be they may be exempt in the country of performance if public funds are being used. And then there are certain bases of relief which are given over there. Now, let's look at certain specific treaties entered into by India, right? Where there is a time threshold given and a fee threshold is given. A time threshold is given between the treaty between India and UAR, the United Arab Republic. Right. In that case, it is not Article 17, it is Article 18. Article 18 provides that income earned by artists, athletes shall be taxable in the source country if the personal activities exercised are for a period exceeding 15 days during the year. Right. Then there's a fee threshold given under India-US treaty, where it says that the net income should exceed USD 1,500 or its equivalent in Indian rupees. Then there is Article 15 between India and Libyan Arab, which does not provide for paragraph 2 itself. So there is no Article 17(2) over there. And hence, if payment is received by the company, the same shall not be taxable as per the treaty. In this particular treaty, it's Article 15. Now, let's go on to taxation in India, which we will be covering Section 115 BBA and Circular 787. Now, let's start with Section 115 BBA. Section 115 BBA basically provides for gross income of taxation for non-residents. So, any non-resident sports person, non-resident sports association, entertainer, right? Earlier, this particular section was applicable only to sports person and sports association. In 2012, they amended the law and they have now included entertainers also. The rate of tax provided in India is 20% plus applicable surcharge and cess. Now, the heading of the section still reads taxation of non-resident sports person and sports association, but entertainers have been included since 2012, though the heading of the section has not been changed. So, what does Section 115 BBA say? It says with the total income of an assessee being a sportsman, including an athlete who is not a citizen of India, right? So remember that person has to be a foreign citizen, not a citizen of India. Only then 115BB applies. It is not only residential status, it is also citizenship in this particular case. So for example, if there's a citizen of India who is moved outside India, right? And he comes and does performs in a cricket match in India. If he's not a citizen of India, he continues to hold an Indian passport, then 115BBA does not apply to him. Income has to be received from participation in India in any game, right? Other than a game of winnings, to which 115BB applies, any sport, advertisement, contribution to articles of any game or sport in India in newspapers, magazines, or journals. The second category is non-resident sports association or institution, which includes any amount guaranteed to be paid or payable to such association in relation to any game. Again, not which is taxable under 115BB or any sport played in India. The third category is an entertainer, being an entertainer who is not a citizen of India. Again, so I don't know Priyanka Chopra's citizenship status, but if she continues to hold an Indian passport, she's a non-resident and she comes and does a show in India, then 115BBA will be applicable to her only if she's not a citizen of India, right? If she continues to hold an Indian passport, then 115BBA is not applicable. This is only for an example, right? I don't know her citizenship status at all. So being an entertainer who is not a citizen of India and is a non-resident includes any income received or receivable from his or her performance in India. Now, in all of these cases, the income tax shall be taxed at the rate of 20%. Okay. This is the same rate at which you also have to deduct TDS, right? No deduction of any expenditure is allowed. Hence, it is on gross basis, right? And it is, if you do not, if the total tax has been deducted under 20.8% in India, then the non-resident does not have to file a tax return in India. So that exemption has also been given. Now, so which are the types of income which is covered? Any participation by a non-resident sports person other than your crosswords, lotteries, etc. Any contribution to any articles or news association, any amount guaranteed to be paid. And the section under which you have to deduct taxes is section 194E. So generally for all residents, we deduct under 195. In this case, there's a separate section for it, which is 194E. Now, the next part is what is not covered under 115BBA, right? So, period of stay in India includes not only shooting, it could include promotion and practice sessions, right? And this is only taxable under the act that we discussed, 115BBA. And the rate of withholding tax is under 194E. But now what happens to a person who becomes a resident in India during the year? Say their number of days exceeds 180 days because they came for shooting, they did some promotion, they did something. And their residential status during the year changes. And they also end up staying in India for more than 180 days, right? Then you have to check each person's residential. So if you are, say, a company who's making a payment to them, you have to be sure that what is their residential status before you deduct the tax. This is the whole section. Now, let's go on to Circular 787, right? So this is Circular 787, which is dated 10th February 2000. Okay. After this Circular 787, there has been no other circular in India on the specific taxation for entertainers. So the CBDT had issued this circular, which provides guidelines regarding the taxation of income of artists, entertainers, sportspersons from international, national, and local events. This circular also includes income received by an event manager, artist management, or intermediate company, right? Our examples over here are only covered for the artists, entertainers, and sportsperson. So, if an artist performs in India without any consideration, there would be no income and hence there would be no tax. Similarly, when the artist performs in India to promote sale of his records and no consideration is paid for performance by the record company, then there will be no tax as nobody is receiving any income for the performance in India, right? So there is no income from performance, then there's obviously no tax. Any consideration received by artists or performers for the live performance or simultaneous live telecast or broadcast, it could be on radio, television, internet, in India would qualify as income and consequently would be taxable. Even if separate consideration is received for simultaneous telecast of performance, the same shall be taxable in India and will be treated under the article artist or sportsperson in the DTA, which is Article 17. Then consideration paid to artists to acquire the copyrights for performance in India for subsequent sale abroad, which could be of your records, CDs, etc. Or the consideration paid to artists for acquiring the license to broadcast or telecast overseas is not taxable in India because there is an exemption governed under 916, right? Because when a live performance is happening, ideally, there is no royalty yet. And under 916, there is an exemption given for that. Then the consideration paid to an artist to acquire the copyrights for performance in India for subsequent sale in India, or the consideration paid to the artist for acquiring licenses for broadcast or telecast in India would be taxable under 916 as royalties. Then if there's any portion of endorsement fees which relates to the artist performance in India, that shall be taxable within Article 5, as this would fall under artists and sportsmen under 115 BBA also. And the circular provides that the non-resident entertainers or sportsperson may be required to obtain a tax clearance certificate under Section 230 of the Income Tax Act from the competent authority. Now, practically, nobody, goes and takes the tax clearance certificate anymore, right? Because the whole thing has changed and it is now taxed directly at 20%. So there's no question of, taking any tax clearance certificate. This circular is also fairly old. I don't think it is updated for what happens to a YouTube right, for example, right? Because when I had a record or a CD, I was able to say in which territory I'm going to sell it. But for example, if they're acquiring a right and it's being shown on YouTube or a Netflix or any other medium, right, which is an online medium and online streaming medium today, everybody can watch it, right? So Netflix, etc., may still be country specific, but a YouTube is not. Anyone, anywhere can watch it, right? So this circular maybe needs to be updated to what happens in such particular rights, okay? And what kind of right should be given to the country in which it is being viewed? Or can there be a way where all the countries maybe divide the proportion? Now let's go into a few case laws, right? Where we are going to deal with Article 17 and Section 115 BBA. So there is a decision of Viscraft International where Viscraft is engaged in the event management and they organize certain events, right? Now here they paid money to a UK agent, right? There was money paid to the artist for which they deducted tax under Article 80. Then there was reimbursement of artist expenses, which they did not deduct tax, and there was commission and reimbursement to the UK agent. So they said that they had not rendered any services and hence no tax was deducted. Here they said that because the UK agent did not have any PE in India, hence no TDS was liable. For reimbursement also nothing was liable. Now we'll quickly do about 2 or 3 case studies and then we'll move on to the taxation of individuals, right? So here, let's look at the first case study. So there's Akon, who is an American singer who visited India for live stage performances hosted in 3 cities by a foreign management company, FO. And in India, the person coordinating was an Indian event management company, ICO. His total remuneration was 4 crores. The Indian company also released a compilation of audio and video CDs, DVDs on the concert released globally by XYZ Music Company and Indian Music Company, and remuneration paid was 1 crore on acquiring the rights by XYZ Music Company. He appeared guest appearance on Indian Idol where he was paid 50 lakhs. There was a dinner hosted in his honor. There was a payment of commission of 20 lakhs to the foreign company, right? So now let's understand what will be the taxation over here. the remuneration for direct performance, which is 4 crores that he's getting, that would be taxed directly under 115 BBA, right? Because Acorn is a foreign citizen and non-resident. When rights are acquired by XYZ Music, you will apply Circular 787 and say subsequent sale is abroad. Hence, it is not taxable. Subsequent sale is in India and hence it is taxable, right? And if they've taken the rights to release it globally, then you have to apportion the 1 crore between India and other than India. The guest appearance on Indian Idol, where he's got 50 lakhs, is again from performance, right? Because he's gone and done some performance, just appeared. That itself is 50 lakhs, which is taxable under 115 BBA. Then the FCO's commission income would not be taxable in India based on the Viscraft decision. And if Indian company made the entire payment to foreign company, then foreign company would also be taxable on the proposed portion of Acorn's remuneration in India under Article 17. But there's an interesting question here. So when they would be taxable on Acorn's remuneration in India under Article 17, then would it go under 115 BBA or would it go under normal provisions of the Act? Because Section 115 BBA does not cover over here an Article 17(2) situation where the money is not received by the entertainer or sportsperson themselves, but it is received by a company. So when this section was amended, we had made a representation also saying that what about a 17(2) case, right? Why do you want to include a company here? That was not considered. So in this case, if they made the payment directly, then as per Article 17, the rate applicable to a foreign company would become applicable, right? In which case it could be 40%. And gross basis because there are no expenses that I can claim. And then the foreign company would have to file a tax return in India, maybe claim expenses that are paid to Acorn as a salary and claim a refund. So 17(2) situation is not covered under 115 BBA. Hence, you have to be very, very careful while advising the client on some scenario like this. So we always recommend that the payment goes to the artist or entertainer directly. So you can directly apply 115 BBA. Otherwise, the foreign company would have to, the Indian company while making payment to the foreign company would have to withhold tax on gross basis again at 40%. And then the foreign company would have to file a tax return in India, claim the expenses and claim the refund. Second case study. Mr. A, who's a Brazil resident, he's contracted by a US club to play IPL in India, Sri Lanka, and China. Then there are playoff matches in India, Sri Lanka, and China, which are played over 3 weeks, and there's a final match in India. And then there are approximately 2 matches which are being played a week. There is an income for the club. So the prize money for winning the IFL is 10 crores, and of which 50%, 5 crores will be distributed among the players. And what is income of Mr. A? He gets 2 lakhs, including time spent for training for as a monthly compensation. He also won a player of the series, so he got 10 lakhs. Then he got a share of prize for winning the IFL. Then he did sports brand promotion fees because he during the matches he wore gear, and for that he got 2 crores. And then he got 5 crores for wearing the gear, say Adidas, Nike, whatever, in public appearances. Then he also did a guest appearance in a Bollywood movie and he got 50 lakhs for that. So what will be the taxability? So 2 lakhs is directly related to performance and hence taxable under 115 BBA. 5 lakhs is during public performances, appearances. If it is not related to any performance, then not taxable under Section 115 BBA. The amount he received for guest appearance in a Bollywood movie would be taxable under 115 BBA. The income of the club prize money would be taxable under 17(2) over here. And even if the club is a sports association or institution, prize money is not covered under 115 BBA since it is not a guaranteed payment for participation. Hence, this would be taxable under net basis under normal provisions of the Income Tax Act, which are applicable to a foreign company. Okay, here. Now let's do one more quick case study and let's move on to the professionals, and we'll keep 5 minutes for question answers. Now let's go to one more case study of the Mumbai Marathon. So as you are aware, the Mumbai Marathon will be coming in January, in less than a month away, right? And you have these celebrities, industrialists, they're all running for an NGO. Now, but who wins the marathon, right? It's never an Indian, it's always someone from Africa, right? So why do they come to run the marathon in India? They're invited by the organizers or through a sports association or through a management company, right? So they get participation fee, prize money, advertisement, contribution to articles, and reimbursement of expenses. In this case, all of this, because there's a non-citizen and non-resident, this is applicable at 20% and hence not, liable to file a return in India, right? And, the rest of it is, if it's through a sports association, then again, not covered under 115 BBA. Now let's look at some quick questions, right? What happens if Shah Rukh Khan becomes a judge on a TV show in the USA? We have to check the local domestic laws of USA to check whether he has to pay tax over there, whether he has to file a return over there. But he is a global resident in India, and global income is taxable in India. Hence, whatever is paid over there, he has to show the income here also and claim credit of taxes. If Hugh Grant comes on Coffee with Karan, if he gets paid for it, then he would have to pay tax under 115 BBA. A foreign artist shoots for Hindi film for Indian audience, but shooting is outside India, right? In that case, India cannot say there's a performance in India, and hence Article 17 should not be applicable. Then there's a match between Hollywood and Bollywood artists in India, right? And then this is organized by an event management company, and tickets are sold to general public. So can you say over here that they're performing as entertainers? Yes, in a way, because they're actually not cricketers. They are playing a cricket match for which tickets are being sold and they're getting money for it. And hence you can say that here also they're performing as entertainers. Now we'll take another 5 minutes to do taxability of professionals, right? So in India, first let's do in India and then we'll go to cross-border. So in India, there are no specific provisions under the Act for the creative team as well and the technical team. The income and method of accounting and the similar issues that we've already discussed for entertainers apply equally to other professionals as well. Now, let's go to cross-border taxation. So, in cross-border taxation, let's understand the two articles that would be applicable over here, right? There are Article 14, which deals with independent personal services, and there is Article 12, which deals with fees for technical services. Now, what categories would get covered under Article 14, and then what categories would get covered under Article 12? The general meaning of the term independent personal services implies that services are rendered which are independent and personal, right? So what does it include? The most articles, and we've discussed OECD over here, but it includes independent scientific, literally artistic, education or teaching activities, as well as any other professional activities. So now services performed by directors, choreographers, etc. They're not specifically included in professional services, but since it is a inclusive definition which covers artistic activities, the services performed by various professionals in the media and entertainment industry could be covered by the IPS clause. In most IPS clauses, there is an exemption given that if there is no fixed space available to the individual outside India, and the stay, say, below 90 days at the threshold of 90 days or 183 days, then it should not be taxable outside India. So say, for example, a person who's a director, right? He goes outside India and he, is a director of a particular movie. So whatever income he gets, right, you'll have to apply, see, the India-US tax treaty. Figure what is written in the IPS clause over there. IPS clause with US is 183 days plus no fixed days. So as long as he doesn't stay for more than 6 months and he is, doesn't have a fixed base over there, then that income would not be taxable in the US. But you would have to basically check with a US CPA who can do better, who can guide us better on how this will work. Now let's go to the technical services, right, provided by the technical team, right? So the technical crew would be covered under Article 4, Article 12, right? Now, Article 12, for FTS is a very detailed article wherein, there is technical, managerial, consultancy services. So here we'll have to figure what kind of technical services are being rendered, correct? Over here, you should also note that there are a few treaties with India which have a make available clause like US, UK, Singapore, Netherlands. And in those countries, if the services don't make available technical knowledge, which basically means that the technical person does not teach anyone how to render those services, in that case also there should not be any taxability of that person outside India or similarly of the technical person in India. Now, there could be a case where the payments could be categorized both as IPS and FTS, right? So, a relevant question here would be that whether I can choose to be governed under the IPS clause. So, there is an AR decision where it has been held that the income of the assessee falls under two separate articles of the tax treaty, then the more beneficial article should be applied. So, for example, it falls under IPS as well as FTS, right? But this is not a make available treaty, and the FTS clause would say taxing me at 10%. Then, in that case, I can say that the beneficial clause to me is IPS, and hence I should apply IPS. So, I would not go under that. I would recommend to go under which is the most specific clause applicable to me. So, if my services are more of a technical nature, I would still go under Article 12, right? And if my services were more of an artistic nature, then I would go under Article 14. So with this, whatever had to be covered, we have covered over here. We can open up the house to questions if there are any.
Thank you so much, ma'am. If anyone have any query or questions, please just let us know.
Rakesh ji, just check in web admin. Have we received any queries?
No, ma'am. We have
Because
not.
here we are not going to receive any query.
No, we have not received any query. So
Yes, now we may go for Rajesh Mehra ji.
yes. So now I would like to introduce our next speaker, C. Rajesh Mehra sir, who would guide us on how accounting for movies is being done. And he is a chartered accountant having 25 years of experience across sectors, have experience in IPO engagement for listing in India and overseas, have experience under IFRS and US GAAP, and closely worked with team responsible for publication in media sector and worked with ICI on a technical guide for film sector. Please, sir.
Yeah, thank you everyone and the Institute for this opportunity to present today. I would like to say a very good afternoon to all my friends and fellow colleagues. I will just share my screen. Okay, is my screen visible?
Yes, sir. Yes,
Okay.
sir.
So all of us are consumers of movies and most of us, I think, consider movies to be, including web series, to be one of the most potent sources of entertainment for all of us. And as you will all agree that, while all of us go to the theater or on a TV, watch 3 hours of content and get entertained, but there is a lot of effort and a lot of, activities involved in the background before any of this content is made available to us for public viewing. And that is where, there are multitude of arrangements, multitude of contracts, and therefore related, accounting implications and challenges, if I may use the word. So what does a typical movie entertain? I mean, what is it that constitutes the production of a movie before it is available to telecast? as you're all aware, the chief originator of any content is the producer. He is the person who generally puts in the money and gets all the resources together to make the product available. Obviously, there's a cast and the related crew which is involved. There's a director, a content creator. There are also financiers who pool in the money, expecting to make uh, some profit once the movie is released and exploited under various streams. There are a host of pre-production activities involved before the shooting of the movie actually starts. There is the entire production process, and it then ends in the entire post-production activities, whether it is editing of the movie, dubbing for the movie, special effects, the VFX crew, before the content is finally available for public viewing. As you all aware, today we have various streams of revenue, starting from theatrical exhibition, we have exploitation of music rights, satellite rights, which includes television, OTT, DTH. We also have film merchandising, particularly for various popular content. For example, Disney sells popularly its characters as Disney toys. We have various Hindi movie characters who are sold as toys for kids, where the kids idolize these actors. There is also a lot of revenue which comes in today from in-film advertising and new age media, or the social media. Video content, home video is still popular more in the West, though not as much as in India. And the popularity is declining with the advent of OTT. So let's see, what are the various aspects that we need to be careful about or cognizant about when we are accounting for movies. We are today looking at these elements purely from a producer's perspective. So the first question from an accounting perspective is, what is a movie? I mean, if today any of us, buy a piece of furniture or a computer, for example, we all of us know that it is property, plant, and equipment, and this needs to come into the books of account as such and is depreciated over its useful life. So from that context, where does this place a movie to be? The accounting standard defines an asset as tangible objects or intangible rights which are owned by an enterprise and carry probable future benefits. So if we relate this to a movie, it is safe to say that a movie is an asset, as it is a right which is owned by an enterprise, which is the producer of the movie, for deriving economic benefits through its exploitation. So why we say that the movie is an asset or an intangible asset is, let's see what are the key characteristics of a movie. A movie is an identifiable resource. This could be internally generated as a producer making his movie on his own, or he could be acquiring the content from another entity. So for example, a Karan Johar or a Yash Raj production, may buy a movie produced by a smaller producer, in which case it becomes an acquired content. The entire movie is a right. That right is registered under the Copyright Act of India. It is also registered with the censorship authorities. So therefore, the movie is a right where the ownership rests with the producer. It does not have any physical substance. So today, movies are generally distributed in the digital format, even for theaters as such. Earlier we had those larger rolls where the reels would be carried from one theater to the other, but now most of it is electronic or through satellite. And therefore, we don't often see movies in physical format. They may be stored in a physical format, like, they may be stored on cloud, or they could be stored on a disk, but they don't generally have physical substance. There is existence of active market, or at least expected to be an active market for exploitation of the movies. And the producer of the movie expects that he will derive future economic benefits. And all of these criteria, therefore, point towards classification of the movie by a producer as an intangible asset. Having classified the movie as an asset or an intangible asset, there are three related aspects to be taken care of. First, what is the useful life of that asset? Having determined the useful life, what is the amortization policy that is to be adopted? And third is, how do you account for the exploitation of the right in that asset? So in case of a movie or any intangible asset, the useful life is either the period of time over which an asset is expected to be used by the enterprise, or the number of production or similar units expected to be obtained from the asset. Now, one may argue that, when we classify a movie, whether it has a finite life or an indefinite life. Some people may say that, classics such as Mughal Azam, for example, have an indefinite life because movies made in the 40s and 50s are relevant even today, both in India as well as some of the, old Hollywood classics that all of us have enjoyed over the years. But if we see as a trend or as an average, I think it is safe to assume that exploitation of movies, unless it's a super duper hit, for example, like Mughal Azam, but in general, what we've noted is that exploitation is usually not indefinite, but based on historical trends, they have a finite life, and classification of useful life or assumption of the life to be finite is more appropriate. We next come to what is the value chain, and how do we deal with the value chain for movies? Just give me a second, some problem with my screen. So movie rights could be of two types. This could be self-generated rights, or where, as I explained, the producer himself entails the entire production process. And therefore, what we need to be careful about is what is the cost of a movie? What are the expenses which one needs to capitalize as part of the cost? As per Ind AS, the cost of an internally generated intangible asset comprises the sum of expenditure incurred from the time when the intangible asset first meets the recognition criteria. So why do I say it first meets the recognition criteria? Because friends, as you may be aware, for any intangible assets, there are two phases. The first phase is the research phase, and the second phase is the development phase. And as per the accounting standard on intangible assets, any expenses incurred on the development of the asset during the research phase needs to be expensed off. It is only once the research phase is over that one looks at capitalizing the expenses. And how does it, work for a movie? In the case of a movie, we often see scenarios, where a producer will carry out various activities. He will start thinking of an idea on which to make a movie. He would then consider who is the director he wants to engage, which are the artists he wants to involve, who is going to write the script for the movie, who is going to do the music, what is the theme or the storyline of the movie. And all these are, analogetical to the research phase, where there is nothing concrete. It is at this stage that it's only an ideation or a wish to make a movie. It is when some of these pieces come together and are clearly identified is what is generally considered as a commencement date for a movie. It is therefore the date when the project has been conceptualized or identified, and this could be evidenced in various ways. It could be as simple as a Muhurat shot when it is first taken. It could be finalization of the key elements of the movie. For example, the script is locked in, the actors are decided upon, the production house or the line producer who will actually do the shooting and will be identified. So all these phases or all these characteristics or elements, when they are frozen, is usually regarded as the commencement date from where all the costs which will be associated with the movie will be pooled together as a separate project cost and therefore merit capitalization. Any expenses which are incurred prior to this date, including any advances that may have been paid, these are usually charged to the profit and loss account. When I say advances paid are, advances which you don't expect to later on use in the movie making production process. But say, for example, you have two ideas in mind, or you have one idea in mind, and you engage two script writers to write the script for you. Ultimately, you decide to go ahead with one particular script. Therefore, the expenses incurred on the other script is expensed off as soon as one script is finalized and the movie is on its way towards being produced. So what comprises production cost? Simply put, it includes the cost of talent, whether it is the director, the lead cast, the support cast, various assistants, script writers, choreographers, cinematographers, music directors, lyricists, the production crew, makeup artists, costume designers, and where a content has been acquired or a right has been acquired. Say, for example, for making the movie Three Idiots, royalty would have been paid to Chetan Bhagat for his storyline on 5 Point Someone, on which the movie was adapted. So that is also a direct cost of making the movie and therefore forms part of the cost. There are production expenses. These are the raw film costs, the shooting costs, costumes, set costs. There are various pre and post production costs, which is dubbing, processing of the movies, special effects, legal and professional charges for drafting the various agreements. Then there is allocable expenditure. So when I say allocable expenditure, it is expenditure directly attributed or allocated on a reasonable and consistent basis. So for example, if you have a large production house, say Zee Films or Zee Tele Studios, they would have their own employees who would be involved into the day-to-day activities in the production of the movie, and therefore their salary cost, to the extent it is allocable based on the time spent on the movie, that would also merit capitalization as an allocable expenditure. Borrowing costs eligible for capitalization. So this is a very tricky topic, and I have a separate slide which deals with it. But if the borrowing cost meets the definition of a qualifying expenditure, that could also potentially be capitalized. And as I mentioned earlier, film costs are accumulated on an individual project basis on the commencement of the project. We first come to the accounting for the artist cost, because this is where we see a large amount of complexity in the way some of these agreements are structured. For other expenses, whether it is line production, it is the director's cost, post-production expenses, these are usually project specific. The contracts are project specific, and the accounting therefore is pretty simple. In terms of artist costs, what we've seen over the years is producers may engage artists for a specific identified project, or there are cases where the particular producer may sign a deal with the artist for, say, a 3 film project, and therefore the question arises is how do you allocate or how do you account for the cost of the artist? Where it is specifically identified to a particular movie or a project, it is accounted for based on the price mentioned in the agreement, and therefore is simple from that perspective. However, where say a Karan Johar engaged Siddharth Malhotra for a 3 project deal starting with Student of the Year, the question which arises is, there could be 2 scenarios. One where the price to be paid to the artist is mentioned for each specific movie, or there could be a bulk deal where the total amount to be paid to the artist for 3 movies is defined. Now, in case of any such bulk deals, the practice is usually to allocate a fair value depending on the scale of the project, the popularity of the star involved, and that is how it is a judgmental area, but this is how the accounting follows. What is also increasingly complex is some of the agreements where we have variable consideration payable to the artist, which is typically called as participation cost from an accounting perspective. So participation cost arises in cases where parties involved in the production of a movie are compensated partly by contingent payments based on the financial results of a movie based on the contractual arrangement. So, for example, for a Salman Khan movie, the producer may agree with Salman a fixed amount and also agree that in addition to the fixed remuneration, all the proceeds from the exploitation of a movie, say in a particular territory, say Mumbai territory, there will be a percentage share in the overflows or the inflows coming in from that territory. Or, they may assign the distribution rights of a particular territory to the artist concerned. Now, there is a standard on provision and contingency. We say that a provision is required to be made if there is a present obligation arising out of past event, which is likely to result in outflow of resources, and the outflow can be reliably measured. So whilst a participation cost under an arrangement will meet most of these elements of the definition, what is the uncertainty is the outflow, because before a movie is released, it is very difficult to predict what is the outflow that can be anticipated. And therefore, we see that participation costs are usually accounted for, when they arise or when the related revenue stream materializes, and are therefore required to be disclosed as a commitment in the financial statement. As I touched upon earlier, we could have different types of agreements for making a movie. In addition to the principal producer, we could also have scenarios where there's a co-producer involved. Here, there could be two types of arrangements. The first is where the co-producer is merely a financial investor in the project and he does not get involved in the day-to-day activities. In such a case, the monies which is put in by the financial investor is considered purely as a debt and accounted for accordingly. However, where the co-producer is an active participation and a joint owner of the corporate. So both of these aspects are important from an accounting perspective, that he is a party to a joint venture, which therefore classifies the entire arrangement as a jointly controlled operation. Both the parties involved account for their share of revenues, costs, assets, and liabilities associated with the movie. The next type of arrangement I referred is where a producer buys the movie outright from a production company. They may either produce a completed product or require that the production company make a movie on their behalf and sell it to them. In both these cases, the cost of the acquired right or the movie includes its purchase price, any duties and taxes to the extent these are not recoverable from the authorities, and any other directly attributable expenditure made. So, for example, a producer may acquire right to a foreign movie for distribution in India, and say it's in Spanish language. Obviously, to cater to the Indian market, the producer will either have to get it dubbed into English or any other regional language, depending on the market where he wants to distribute the movie. So all such expenditures are directly attributable to the cost of the content acquired would form part of the cost of the movie itself. Coming to borrowing costs, and we have seen instances, or it's commonplace for producers to book artists well in advance. So based on the availability of dates of the particular artist, huge amounts of monies may have been paid to block the artist for a particular project, say to be commenced 2 years down the line. Now, there is a strong view which exists that since the advance has been paid, there is a definitive intent for the project, and other aspects would be finalized only once the shooting commences. In many cases, we've also seen instances where the producer's project depends on the availability of the lead star and revolves around that star. However, from an accounting perspective, even though a large part of the cost would have been incurred in booking the artist, so to say, this cost of holding the artist does not qualify for capitalization as borrowing cost. And even though say the amount has been paid more than 12 months in advance of the commencement days, and therefore the presumed qualifying period of 12 months has elapsed or is likely to elapse before the movie commences, the fact that it is only a holding cost, and there is a specific mention of this aspect in the borrowing cost standards, it is required to be expensed off and cannot be capitalized to the cost of the asset. We next come to exploitation costs, and when I refer to exploitation costs, these are generally of two types. One is the cost of making the prints. So, as I mentioned earlier, in the entire chain of producing a movie, the entire movie when it is shot, it is shot on raw film, and that film after editing and various post-production activities is then finally delivered either on a roll or in a digital format. And if there is any cost of duplicating the CDs or the rolls, this is treated as an exploitation cost. But since it is not directly relatable to the production of a movie, but only in terms of multiplying the copies available thereof, it is charged to consumption as and when it is incurred. There is a very peculiar, sort of accounting issue related to accounting for advertisement expenses. And let me try and explain. As you may be aware, a lot of expenses are incurred by the producer for the promotion of a movie prior to its release. So, for example, we'll see various promotions on television, YouTube. We'll see hoardings all over the city, newspaper advertisements for the movies. There'll be expenses incurred for holding promotion parties, promotional campaigns where artists go to various cities to create a buzz around the movie. Historically, a view existed that since these are expenses which are necessarily to be incurred to generate an audience for the movie or to make the movie popular or create an interest, which will entice the viewers to go to the cinema halls or switch on their OTT platforms to watch the movie, these should be added to the cost of the asset, or these should be deferred at least till the date when the movie is released. And for listed companies, this created and still continues to create a huge amount of potential fluctuation in the way the P&L is projected. However, the accounting standard is very clear for an intangible asset that for internally generated intangible asset, the cost of selling, administrative and other general overhead expenses cannot be capitalized. The only exception is, and to this is, where there is a direct correlation, not between the advertisement and the product, but between the advertisement and the benefit derived from the product. So, for example, in some of the developed countries in the West, you have direct response advertisements where it is possible to correlate that, what is the benefit or the actual revenue which emanated from that direct response advertisement. However, for movies, such measurement is not possible. And in the absence of such measurement, any advertisement expenditure incurred in relation to a movie needs to be expensed off as incurred. Because, for example, I may create a buzz, but ultimately that creation of a buzz does not necessarily guarantee me footfalls for the movie, or there is no way of measuring that if a particular person went to a theater to watch a movie, whether it was out of his choice habit or was it a result of the advertisement, which created the interest in him or her to visit the theater to watch the movie. So to summarize in brief, the various components, acquisition cost or production cost, we capitalize in the books of account. Borrowing cost is generally expense unless it meets the qualifying asset criteria. Participation costs, because these are difficult to measure with accuracy at inception, are expensed as they are incurred. Exploitation costs are expensed, and all selling expenses, including advertisement costs, are expensed as incurred. So having dealt with the key aspects of the asset, which is a movie, and that is cost on one hand and what is the useful life of the movie on the other. The next logical question is, once a movie is released or ready for exploitation, what is the basis for amortization of the cost of the movie? Now, I'm dealing with this purely from an accounting perspective. Taxation has its own laws in terms of what will be allowed as a cost of the movie for tax purposes. But purely from an accounting perspective, friends, let's see how amortization is to be accounted for. Under IFRS or Ind AS, as we have it now in India, there is no fixed principle which has been laid down for amortization of a film cost. Under both IFRS and Ind AS, the underlying principle is that amortization of an intangible asset should be based on the expected pattern of realizing the economic benefit from that asset over its useful life. However, if we go to US GAAP, where most of the large Hollywood studios are located, there is specific literature which deals or prescribes a method for amortization of movies, which is known as the film forecast method, and is generally adopted. So let me briefly touch upon how amortization would differ under the two methods. Under US GAAP, when we refer to film forecast method, what usually happens is at inception, the producer of the content, he will identify the various streams from which he is expected to recognize revenue from the exploitation of the movie. He will allocate an expected value to of each of those streams to come at to arrive at the total expected revenue from the movie. As and when that revenue is incurred or is earned. So for example, the total expected revenue is say 100 from a particular movie. And say out of that 100, 40 is attributable or expected to be realized from theatrical exploitation. So therefore, as and when that 40 is earned, a proportionate amount is amortized. So for example, if a movie today has generated 20 from theatrical exploitation, so 50% of so the theatrical exploitation is say 40% of the cost, and 50% of that 40%, which is 20, will be amortized as and when the movie is released in the theaters. Now, if at the reporting period end, if the producer expects that he will reach 40, he will hold on to further amortization. But if, say, the movie at a period end or at the reporting period end has outlived its theatrical life, and 20 is what is expected out of the 40, the entire 40% of the cost will be amortized. In this scenario, under US GAAP, you will not have the ability to take hindsight benefit and transfer the 20 cost which is unrecovered from theatrical to say satellite, if he manages to sell satellite at a value higher than what was anticipated. However, under both IFRS and Ind AS, what a producer will do is he will estimate the period over which he expects to derive economic benefit. So what the producer will do is, for example, he says, I expect to recognize, say, 40 or 50% of the economic benefit from theater, 30% from satellite. And when he comes to satellite, he will say, okay, 30% is from the first sales, 20% in the second sale. Simultaneously, I'll have some revenue from music, etc., etc. So whilst back of the envelope calculation would more or less, come to a film forecast method, but he would still need to, one, estimate the useful life and estimate what percentage of revenue is he expecting at over what periods of time. So what percentage of revenue is it that he expects to earn in year one, year two, year three, etc., till he reaches full amortization. So practically, whilst they may follow a similar path, but unlike US GAAP, IFRS and Ind AS specifically spell out that unless the producer is able to demonstrate specific correlation dependency between the cost and the revenue, it is not a permissible basis of calculating amortization, and therefore has to be based on the expectation. Plus, practically what the producer will do is, for a particular genre of movies, he may rely on his experience based on past trends, coupled with the current market conditions, and therefore arrive at a basis of amortization. There is no right or wrong here, unlike US GAAP, and therefore we may see varied practices for different productions house, varied practices for different genres of movie. In fact, the amortization method, for example, may also vary, say, for a Hindi movie and a South Indian movie, because their means of exploitation or the producer's ability to derive benefit may vary. And it may also depend on the scale of the project which is being produced. Once the normal amortization has been carried out, the next question which arises is testing for impairment. So the accounting standard is very clear that any intangible asset needs to be tested for impairment, at least at each balance sheet date, and whenever there is a trigger for such impairment. One question, or a practical challenge which would arise is, in an instance, say, where a movie is released subsequent to the balance sheet date, but before the sign off of the financial statements, the performance of the movie is not expected. So if I step back to what I mentioned about amortization. So for example, you are at 31st March closing a set of books, and therefore based on your expectation of the economic life or the economic benefit from the asset, you decide that a movie which is to be released in April or May, you will say amortized 30% in year one, 30% in year two, etc. Now, in a real life scenario, say that movie releases towards end of April and it does not do well. Okay. All of us know that most of the satellite deals are also probably signed off prior to the release of the movie. The music rights are also sold prior to the release of movie. And therefore we may have a scenario where the movie just absolutely does not do well, but it is an event which has happened after the balance sheet date. And the question from a practical standpoint which arises is whether it is an event which existed as at the balance sheet date and therefore needs to be accounted for or is it purely an outcome which has arisen after the balance sheet date and therefore should be, ignored in accounting for the carrying value or in estimating the carrying value of the movie? Now, while very technically one may argue that, as at 31st March, there was no circumstances which indicated that the movie would not do well, and therefore one should not make an adjustment to the carrying value of the asset. But on the other hand, if you look at the standard which requires you to test for impairment, uh, the projections given by the management for such projects would definitely factor the fact that it has not done well, and therefore, in a practical way, that would lead to accounting for the impairment in the carrying value of the movie. So, having dealt with the various aspects of a movie or the intangible asset relating to its cost, its useful life, the elements of cost, accounting for amortization and impairment. Let's see, how do we deal with the revenue recognition streams and some of the, avenues which are open for revenue recognition and the accounting implications. In terms of both the old Indian accounting standard on revenue recognition as well as the principles laid down in Ind AS 115, an entity should recognize revenue from a sale or licensing arrangement of a film when all of the following conditions are met. One, when there is persuasive evidence of sale or a licensing arrangement with a customer, the film is complete and in accordance with the terms of the arrangement has been delivered for its exploitation, exhibition, or sale. Third, the license period has begun and the licensee can begin its exploitation, exhibition, or sale. I will come to some of these elements of revenue recognition and the challenges. The arrangement fee is fixed or determinable, and collection of arrangement fee is reasonably assured. So in the event that an entity does not meet any of the above conditions or any one of the above conditions, recognition of revenue should be deferred till such time as all the conditions are fulfilled. So let me take some few practical cases where there could be accounting challenges. So for example, as I mentioned earlier, say a production house may enter into a contract with an OTT player, for example, Netflix, saying that after the cool-off period, and which is typically 2 to 3 months after the theatrical release of the movie, Netflix would have a right to broadcast or make available for streaming and viewing the particular movie. Now, in such cases, practically what happens is that Netflix would have, on delivery of the digital copy of the movie to it, would have paid firstly the advance for blocking the movie, and then on delivery of the movie, they would have paid the full consideration. Now, historically, there has been a practice in some cases we've observed where, from a producer's perspective, there has been an argument that all the obligations or deliverables, which is the prerogative of the producer, have been fulfilled. That is, the movie has been completed, the censorship for OTT release has been completed, the product has been delivered to Netflix. Netflix has also paid for the product in this instance, and therefore all the conditions for recognition of revenue are satisfied. And even prior to release of the movie or it being made available on Netflix, it is appropriate to recognize revenue. However, the accounting standard is very clear that where Netflix is not allowed to telecast or make available a movie for screening, in this case, say for 2 months after the theatrical release, the control in that asset has not yet been passed on to the broadcaster or the OTT player. Because even though Netflix has physical possession of the digital content, there is a prohibition to Netflix to not telecast or make available for streaming the content till those 2.5 months have expired. And therefore, revenue recognition is to be deferred till such date as when Netflix can officially make available the content for streaming. If then Netflix on its own accord delays the availability beyond the first permitted date, revenue recognition is permitted for the producer from the date when it is made available. So for example, if the movie releases on 1st of April and for 2 months Netflix cannot, release the movie on its platform, but Netflix chooses to say release it on 15th of June, the producer then, under the accounting guidance, is entitled to recognize revenue on 1st June, that is on expiry of 2 months. The producer need not wait till 15th June when the product is actually released by Netflix. Moving on, let's see the various types of commonly used revenue streams for exploitation of movie content and their accounting. So for theatrical exhibitions, usually contracts are entered. In these scenarios, the producer may have two options. He may ideally reach out to the theater owners to distribute the content or tie up with the shows. But in most of the cases, given the widespread geographical reach and the number of theaters and theater chains which are present, it is not practicable, for the producer to directly enter into contracts with the theater owners. So in these cases, the producer enters into a contract with an intermediary known as a distributor, and the distributor is then allocated the right to distribute the movie in a particular territory for a particular period of time. In such a scenario, there could be two types of contracts that the producer may have with the distributor. If the producer feels that the product is very valuable, it has generated a lot of buzz, and say the producer is confident that he can demand value on that product, he will typically insist on a minimum guaranteed amount to be paid by the distributor, plus a share of the overflow. So, for example, say we have a producer, Yash Raj Films, and say they're coming out with Fighter in 2024. So they may appoint, say, PVR distribution arm to distribute the movie, say, in the territory of Mumbai. So geographically, India has 6 territories, and then there's an entire global market. So Yash Raj may tell PVR that if you want the contract to distribute the movie in Mumbai, I need a minimum of an X amount as a guaranteed income, and any gain or loss, if there's a loss, if the movie does not do well in the theater and you earn less than the X amount agreed, that is to the account of PVR. But if the movie earns more than the X amount, then any earning above X will be shared between Yash Raj and PVR in an agreed ratio. So this is what we call a minimum guarantee arrangement with an overflow clause. Alternatively, there could be a contract with the distributor, says that for every rupee realized by the distributor from the exploitation or from the theatrical ticket sales, X percentage will be retained by the distributor, and the balance will go to the producer. So in case of non-refundable minimum guarantee contracts, the minimum guarantee amount is usually recognized as revenue on the date that the product is available for exploitation. And in case of commission contracts, like any other commission contracts, revenue is recognized as earned. That is, as and when the tickets are sold. From the distributor's perspective, the distributor's share from theatrical exhibition is recorded as revenue as it is earned and is recognized net of taxes and the share of the exhibitor or the cinema owner in this. I'm not getting into the accounting of the right from the distributor's perspective because we are restricting it to the producers. But just spending a minute, for the benefit of friends, if it is a minimum guaranteed arrangement, then for the distributor, it becomes the right to use an asset and is therefore capitalized as such. It is then amortized by the distributor like any other asset over its the economic life or the maximum economic life is as per the agreement between the producer and the distributor. But the amortization principle or the expected economic benefit is based on his expectation as to when does he expect to earn that revenue. Now, in most cases, all of us know that unless a movie is a big blockbuster, usually the theatrical life would span a period of, say about 4 to 5 weeks. And as a practical expedient, most of the distributors would amortize the movie, within that time frame. Coming to music rights in the Indian context and not so much overseas, most Indian movies have a lot of music associated with it and therefore a lot of value attached to the movies. In most instances, we see that contracts for sale of music are entered into much in advance of the release of the movie. These rights are generally sold to music companies on a minimum guaranteed basis and are therefore recognized as and when the music content is available for exploitation to the music company. For the music company, obviously, they would recognize revenue as and when they exploit the movie, whereas the producer would recognize revenue on the date these rights are made available for exploitation to the music entity. Moving on to satellite rights, I touched upon or I explained in detail, the key practical challenge in terms of when revenue is to be recognized. So just to summarize, the principles of revenue recognition will be satisfied when the broadcaster, the OTT operator, or the DTH operator can start the telecast of the movie. And for the television broadcaster, usually it could either be a pay-per-view revenue stream, or if it is part of a subscription, say for example Netflix or Amazon Prime Video, where you pay a particular amount for say the full year, and all content is available free of cost thereafter. Then there is no additional revenue coming to the operator, but any advertisement or subscription revenue is accounted following the general revenue recognition principles. Moving on to merchandising rights, these are generally given to market some of the products where people identify the products with the movie or the star cast of the movie. And these incomes are recognized following the general revenue recognition principle. So the moment the right is given, say, to a toy manufacturer to make products, on sale of that right, revenue is recognized, provided all the articles or the artist impressions and other related aspects are in place. Producers also have streams of revenues emanating from in-film advertising. So let me give an example. So for example, say a Pepsi or Coke, want to advertise the product, and there is a particular scene in a movie where, say the lead cast is at a coffee shop and they order for soft drinks. Now, this creates an opportunity for the producer, to approach, say, a Coke or a Pepsi and say that, look, I have a scene where the lead cast would be consuming cola, and if you want that the bottle of, say, Coke is displayed or Pepsi is displayed, it would be, advertising in a way for that product, and therefore, let's enter into an arrangement where you will, pay me for displaying the bottle of Coke or Pepsi in that particular scene. So this is what we call in-film advertising. And in this case, even though I may enter into a contract with Coke or Pepsi much before the release of the movie, or even before the scene is shot, because I have to decide which bottle is to be put. Revenue here will be recognized only when the movie is released, and this is primarily because of the fact that there should be convincing evidence that the scene which was shot, the scene was shot with that particular product in that scene. And thirdly, the scene made its way to the final product and was not edited out. And therefore, even though Pepsi or Coke may pay for that arrangement well in advance, revenue recognition is precluded till the time that the movie is actually available and has that particular scene in place. If any artist, has any share on these arrangements, then the share of the artist is a participation cost and is accounted for accordingly. So, for example, if Amir is the brand ambassador for Coke, and Coke is the one which has signed up for that scene, then if Amir is entitled to a share of revenue being the brand ambassador, his share of that revenue is a participation cost and will be accounted for accordingly. Moving on to the last segment, which is home video and other new media. These are generally in the nature of fixed fee arrangements for any DVD sales or VCD sales, or any other digital sales. Revenue is recognized on the date when these products are sold to the consumer and are made available for viewing. The last part I would like to cover is certain barter transactions which are prominent in the film industry. So, for example, taking forward the same Pepsi or Coke example. So, on one hand, the producer has an obligation to display the Coke or Pepsi bottle in that particular scene. And on the other hand, Pepsi or Coke says that, look here, I will not pay you for this particular scene, but what I will do is in my X number of advertisements, closer to the release of the movie, I will co-brand the movie or use some sort of relation to the movie when I'm doing the advertisement. So this is what we typically call a barter arrangement. In such barter arrangements, both cost and revenues are accounted for following the normal barter principles. So, for example, if it is difficult to ascribe a value as to how much should I charge, say, Pepsi or Coke for a particular scene, if it is easier to come to a number to be affixed to the cost of the advertisement in the medium where Pepsi has promised to display the advertisement, that could be a basis to arrive at the cost of the barter arrangement, and therefore the producer, will recognize the revenue equivalent to the cost of the, say, the 10 ads that Pepsi has promised, and revenue recognition timing for the producer will be the release of the movie. And for Pepsi revenue, cost would be based on the number of ads as and when the ad is portrayed. Coming to some typical practical scenarios from an accounting perspective. So we do have cases where producers sell multiple rights, multiple rights for multiple films uh, to the exhibitors or the say the OTT platform. So for example, if there's a Tips Industries or say a Yasha Studio, and they have a library of say 10 or 20 movies, and say Star approaches saying that I want for a particular channel that I contract you for the entire library. In such cases, two important points to consider. The first one is that if there is a movie-wise or a film-wise value ascribed in the contract, that is generally treated as the revenue or the cost for the exhibitor for that particular movie. And this is accounted for the date when the movie is available. If there is no bifurcation of cost, then it is either to be accounted for on fair value basis. Practically, it may be difficult for each bouquet to determine the fair value of each movie in that bouquet. And a more simplistic method is to equate and distribute the cost equally. Why I mentioned here again is the date when the movie is available for exploitation by the broadcaster is because, say, for example, as I said earlier, in case of a satellite sale, there are agreements where there are exclusive satellite rights given to broadcasters for the first satellite for the first telecast, and it is only after that period is over that you may assign a satellite right to a second broadcaster. So whilst I may enter into a contract with the broadcaster prior to the expiry of the first satellite period, I will recognize revenue only when the first satellite telecast period is over and the new broadcaster is able to exhibit the movie on his channel. The other principle which is important in any revenue recognition is, whether revenue is to be recognized on a gross or a net basis. The general principles for revenue recognition on gross or net need to be followed here. That is, in determining who is the primarily obliger in the arrangement, what is his or her or the enterprise's discretionary in establishing the price, who has the inventory risk, and whether the party involved or being considered is an agent or principal. So let me give you, the example of a movie being released in the theater. So say, the theater owner sells the ticket for 100 rupees. Here, the theater owner is the primary obliger as far as the customer is concerned because he is responsible for making the movie available on the promised date to the patron who buys the ticket for the movie. So say if a ticket is sold for 100 rupees, the theater owner will recognize 100 net of as his revenue. The theater owner has to say 50% of the ticket price as a share to the distributor. So 50% of 50 rupees would become the cost for the theater owner, and 50 would become revenue to the distributor. Here, the distributor, now depending on what the arrangement of the distributor is with the producer and who meets the definition of the primary obliger, the distributor in some cases may recognize the entire 50 as his revenue and the share of the producer as his cost. Or if he does not meet the definition of a principal and only of an agent, then the distributor will recognize, say, the distributor is entitled to 10% commission. So he will recognize only 5 as revenue, and the balance 45 that he receives from the theater would be his liability to be paid to the producer. So that's largely the broad principles that we consider on a day-to-day basis when accounting for the entire lifespan of a movie from a producer's perspective. Any questions from any members? Happy to take them.
Thank you so much, sir. If anyone have any query, please just let us know. I think in message box we have no questions. Nishi, shall we conclude? So I think we should conclude. Uh, on behalf of ICI, thankful to you for giving your precious time and sharing your knowledge with us. I also want to thank all viewers and participants who joined us and kept their support till end. Thank you so much.
So thanks everyone, and wishing everyone a very Merry Christmas and a Happy New Year.
And Merry Christmas to everyone.
Thank
Thank
you.
you, sir.